Your money is designed to become worthless, not by accident, by design. And the people telling you the economy is strong are the same ones profiting from your purchasing power disappearing. Yeah, that's right. Every time the talking heads tell us the economy is doing great, most of us are sitting at home wondering why we can't afford the same lifestyle our parents had. The experts keep telling us everything is fine, but your grocery bill keeps going up, your rent keeps climbing, and that house you wanted to buy somehow costs twice what it did 5 years ago. But here's the thing, they're not exactly lying to you. The economy can be strong by traditional measures while your purchasing power evaporates. It might not surprise you to learn that headlines about economic strength are measuring something completely different from what you actually experience in your daily life. The simple truth is that money is designed to lose value over time. Not by accident, not because of incompetence, but by design. And if you can look beyond the flashy economic indicators and understand how this system actually works, you'll be much better equipped to protect yourself financially while everybody else is busy celebrating GDP numbers and wondering why they're still broke. This understanding has probably never been more important than right now because we're living through one of the strangest economic periods in modern history. The stock market is hitting record highs. Unemployment is low. Corporate profits are soaring. And yet, ordinary people are struggling more than they have in decades. So there are really 3 different levels of explanation for why your money keeps losing value even when the economy looks great. The good enough for most people level, the economics textbook level, and then the level that considers how money is actually designed and who benefits from that design. Now, most people don't even understand level 1, but I promise none of this is as complicated as the financial establishment would like you to think. And actually seeing how this system works is the only way to understand why it's not working for you. Level 1. The official story. Most of the time, when you hear about inflation or your money losing value, you're getting the official explanation, the one they teach in Economics 101. And it goes something like this. A little bit of inflation is actually good for the economy. It encourages people to spend and invest rather than hoard cash. It makes debts easier to pay off over time. And it gives central banks room to cut interest rates during recessions. The Federal Reserve, for example, targets about 2% inflation per year. This means that every year, your dollar is supposed to buy about 2% less than it did the year before. Now, 2% doesn't sound like much, right? But here's the thing about compound effects. Over 20 years, that's a 33% loss in purchasing power. Over 40 years, it's 55%. Your dollar today buys less than half of what it bought when your parents were your age. But wait, you might be thinking, doesn't the economy grow too? Don't wages go up? Well, yes and no. GDP does grow, corporate profits do increase, the stock market does go up. But here's what they don't tell you in those cheerful economic reports. These things don't all grow at the same rate. According to data from the Bureau of Labor Statistics, average hourly earnings have increased by about 4.1% annually over the past decade. Meanwhile, the cost of housing has increased by 5.5% annually. Healthcare costs have risen by 4.8%. Education costs have climbed even faster. So even though nominal wages are going up, real purchasing power for essential goods is going down for most people. This is where the official story starts to fall apart. Because if you dig into who's actually experiencing this economic growth, you'll find it's not distributed evenly, at all. Corporate profits have grown much faster than wages. Asset prices have grown much faster than consumer prices, and wealth has concentrated at the top much faster than income has grown at the bottom. So sure, the economy might be strong, but for who? Level 2, following the money. For the next level of understanding, you need to do what most economic journalists won't do and actually follow the money through the system. Because the real story of why your money loses value isn't just about inflation targets or interest rates. It's about where new money comes from and where it goes first. Here's something they definitely don't teach you in school. Most money isn't created by printing physical bills. It's created when banks make loans. This is called fractional reserve banking, and it's absolutely wild when you think about it. When you take out a mortgage for $300,000, the bank doesn't have that money sitting in a vault somewhere. They literally create it out of thin air by typing numbers into a computer. Seriously. Now, this system was supposedly designed to allocate capital efficiently to productive uses. Need money to start a business? The bank creates it for you. Want to buy a house? More money appears. The theory goes that this money creation is balanced by money destruction when loans get paid back, keeping everything stable. But here's where things get interesting. Who gets access to this newly created money first? Banks and large corporations. They can borrow at near zero interest rates during periods of monetary expansion. What do they do with it? Well, they're not exactly handing it out to workers or investing in productivity improvements. According to Federal Reserve data, over the past 15 years, corporations have used cheap borrowed money to buy back their own stock to the tune of over $10 trillion. They've also used it to buy real estate, invest in financial assets, and acquire other companies. Notice what's missing from that list? Wage increases, new factories, research and development. So the newly created money flows first to banks and corporations, who use it to buy assets. This pushes up asset prices. Then and only then does some of that money eventually trickle down to wages and consumer spending. By the time it reaches ordinary workers, it's already driven up the prices of everything they need to buy. This is why you can have a strong economy with high GDP growth and rising corporate profits, but still feel like you're falling behind. The money is being created, but you're at the back of the line to receive it. And by the time you get your 3% raise, the cost of housing has already gone up 6% because investors bought properties with cheap credit months ago. Let's make this concrete with an example. In 2020 and 2021, the Federal Reserve expanded the money supply by about 40% to deal with the pandemic. That's an absolutely massive increase. Where did that money go? Well, the stock market nearly doubled. Housing prices shot up 40% in many markets. Cryptocurrency and other speculative assets went through the roof. Meanwhile, wages increased by about 10% over the same period. So if you were already wealthy and owned stocks, real estate, and other assets, you got much wealthier. Your net worth potentially doubled. But if you were just working for a living, you got a 10% raise while everything you needed to buy became 20 to 40% more expensive. The economy grew, corporate profits soared, and you got poorer. This is the Cantillon effect in action. It's named after an 18th century economist who figured out that inflation isn't neutral. It doesn't affect everyone equally. The people closest to the money creation benefit the most. Those furthest away suffer the most. And in our modern financial system, ordinary workers are about as far from the money printer as you can get. Level 3. Money by design. Now we get to the part they really don't want you to understand. Because once you see how money is designed, you'll realize that this whole system isn't just inefficient or unfair by accident. It's working exactly as intended. Money, as we use it today, has 3 main characteristics that make it lose value over time. These aren't bugs, they're features. First, unlimited supply. Unlike gold, Bitcoin, or any other scarce asset, government currencies can be created in unlimited quantities. There's no hard cap, no physical constraint. Just decisions made by central bankers about how much money they think the economy needs. And historically, that answer has always been more. Now defenders of this system will tell you that this flexibility is necessary, that the ability to create money during crises prevented another Great Depression in 2008 and 2020. And there's some truth to that. But here's what they don't tell you. Every crisis response involves creating massive amounts of new money. And once that money is created, it doesn't just disappear when the crisis ends. Since 1971, when the US dollar was completely detached from gold, the money supply has increased by over 3,000%. Meanwhile, the actual productive capacity of the economy has grown by maybe 300%. This mathematical gap between money creation and productive growth is why your money keeps losing value. There's more money chasing roughly the same amount of goods and services. Second, debt-based creation. Remember how banks create money through loans? This means that almost all money in existence is somebody's debt. Your mortgage is money that was created. Your credit card balance is money that was created. Government bonds are money that was created. This has a weird implication. For the system to stay stable, the total amount of debt must constantly grow. If people start paying off debts faster than new debts are created, the money supply contracts. This causes deflation, which makes existing debts harder to pay off, which causes defaults, which destroys more money, creating a death spiral. So the system is designed to require constant debt expansion, which means constant money creation, which means constant devaluation of existing money. It's not a side effect, it's the core mechanism. The Federal Reserve literally has a policy that says they need to prevent deflation at all costs, because deflation would mean debt destruction, and debt destruction would mean the end of the current monetary system. So they will always choose to create more money rather than let prices fall. Your purchasing power will always be sacrificed to maintain the debt pyramid. Third, velocity manipulation. Here's where it gets really interesting. The amount of money in the system matters, but so does how fast it moves. If money changes hands slowly, prices stay stable even with lots of money. If it moves quickly, prices shoot up even without creating new money. Central banks have figured out how to manipulate money velocity through interest rates. When rates are high, people save rather than spend. Money velocity drops. When rates are low, people borrow and spend. Money velocity rises. For the past 15 years, we've been living in an era of near-zero interest rates. This was supposed to stimulate the economy by encouraging borrowing and spending. And it worked, but not in the way most people think. Ordinary people didn't borrow much to spend on consumption. Why would they? Wages were stagnant and they were already stretched thin, but investors and corporations borrowed massive amounts to buy assets. So money velocity increased in asset markets, driving up prices for stocks, real estate, and everything else you need but can't easily buy more of. Meanwhile, money velocity in the real economy stayed low. People were saving more and spending less on consumption. This is why consumer price inflation stayed relatively tame until recently, while asset price inflation went absolutely insane. The result? Two different economies. One for people who own assets, where prices are soaring and wealth is compounding, and one for people who work for a living, where wages are stagnant and costs keep creeping up. So if our current money is designed to lose value, what's the alternative? This is where things get controversial, but stay with me. Throughout history, societies have experimented with different forms of money. Gold and silver were popular because they're scarce and durable. Seashells and stones worked in isolated communities. Cigarettes became money in prisons. The key feature that made something good money was that it couldn't be easily created or manipulated. Today, we have technology that allows us to design money with specific characteristics. Bitcoin, for example, has a hard cap of 21 million coins. No one can create more, not even its creator. Love it or hate it, this represents a fundamentally different monetary design where scarcity is built into the code. But you don't need cryptocurrency to have better money. Some economists have proposed systems where the money supply is automatically adjusted to match economic growth rather than debt creation. Others suggest commodity-backed currencies that maintain purchasing power over time. Still others think that competing currencies should exist simultaneously, letting people choose which one they trust. The point isn't that any one alternative is perfect. The point is that our current monetary system is a choice. It was designed by people with specific goals in mind, and those goals weren't necessarily aligned with preserving your purchasing power or ensuring broad-based prosperity. Central banks openly state that they want 2% inflation. That means they want your money to lose value. They've designed a system where this happens automatically, where the people closest to money creation benefit most, where asset owners grow wealthier while workers fall behind, where debt must constantly expand and money must constantly lose value or the whole thing collapses. So what do you do with this information? Well, first, stop believing that your financial struggles are your fault just because the economy is strong. The economy being strong doesn't mean your money isn't losing value. It often means the opposite. Second, understand that holding cash is a guaranteed loss over time. This isn't financial advice, but mathematically, money in a savings account earning 1% interest while inflation runs at 3% means you're losing 2% per year. That's by design. Third, recognize that the system pushes you toward either becoming an investor or falling behind. This isn't fair. It creates enormous inequality. But understanding it helps you navigate it. The wealthy already know all of this. They don't hold much cash. They own assets. They borrow cheap money to buy more assets. They benefit from inflation because their debts get easier to pay while their assets increase in value. Meanwhile, workers and savers get crushed because their purchasing power declines while their wages barely keep pace. The gap between these two groups has grown faster in the past 15 years than in any period since the 1920s, and it's accelerating. This isn't happening because rich people are working harder or being more innovative. It's happening because the monetary system is designed to transfer wealth from people who hold money to people who hold assets, from workers to owners, from savers to borrowers, from the back of the line to the front. Here's the really uncomfortable part. This system is probably going to keep working this way until it doesn't. The people who benefit most from this arrangement control the levers of power. They're not going to voluntarily change a system that's making them incredibly wealthy. But unstable systems eventually break. We've seen this pattern throughout history. Currencies that lose value too quickly eventually lose credibility. Asset bubbles that inflate too far eventually pop. Inequality that grows too extreme eventually causes social instability. We might not be there yet. The system might limp along for years or even decades, but understanding these dynamics helps you see where the pressure points are, where the risks are building, and maybe, just maybe, where opportunities might exist when things finally shift. The money you earn through your labor is designed to lose value over time. The economy can be strong while your purchasing power evaporates, and the people telling you everything is fine are usually the ones benefiting most from this arrangement. This isn't about being pessimistic, it's about being realistic. Once you understand how the game is actually played, you can make better decisions about how to navigate it. Because at the end of the day, this is all a choice. Money could be designed differently. The economy could be structured to benefit workers as much as asset owners. Policies could prioritize purchasing power over corporate profits. None of this is inevitable. It's just how things are currently designed. And if enough people understand that, maybe we can start talking about designing something better. But that's a topic for another video. For now, just remember, when they tell you the economy is strong, ask yourself, strong for who? When they celebrate low unemployment, ask what those jobs actually pay. And when they target 2% inflation, remember that means your money is designed to lose value, not by accident, by design.